All right, let's jump right in today. We're tackling something that can be a little intimidating, even for those of us who spend our days swimming in spreadsheets. We're talking financial modeling.
Yeah, it definitely has a reputation, and for good reason. I mean, we're essentially trying to build a model that predicts a company's financial future, right? So there are bound to be a few complexities along the way.
Exactly. And we've got this super interesting article here that dives into just why financial modeling can be such a tricky beast. Um, what are some of the things that stand out to you about why this is so difficult?
Well, one of the things that always strikes me is the sheer number of assumptions you have to make. It's not like plugging numbers into a simple equation. You're trying to anticipate how things might play out, and that involves making educated guesses about so many different factors.
Right, and the article makes this point about how even small, seemingly insignificant assumptions can end up having a huge ripple effect on the entire model. It's almost like that butterfly effect thing,
Mhm.
right?
Absolutely. A tiny change in one assumption can cascade through the entire model and lead to vastly different outcomes. And we've seen this happen in the real world too. Remember Rivian, that EV startup?
Oh, yeah, yeah. They had those really ambitious production targets, but then
Well, reality hit, right. Supply chain issues, production bottlenecks,
mm,
all those things their initial models hadn't fully accounted for. It's a classic example of how real-world complexities can throw even the most carefully crafted models off course.
and their stock price definitely felt that impact when they had to revise those forecasts. So it seems like it's not just about making assumptions, it's about constantly validating them, being flexible, and adapting as new information comes in.
Yeah.
Always being ready to tweak those models.
100%. And on top of all that, you've got the data itself to contend with. We're not talking about a small amount of data here. Financial models often involve huge data sets. And it's not just about the quantity, it's about the quality too, making sure it's accurate, reliable.
It's like trying to bake a cake with ingredients that might be expired or mislabeled. You could end up with a total disaster no matter how good your recipe is.
I like that analogy. And even if you've got perfect data and spot on assumptions, there's still the challenge of building the model itself. It's a balancing act, right? You need a model that's complex enough to capture all the essential details, all the nuances, but not so complex that it becomes impossible to understand or explain.
A black box that nobody can really make sense of.
Exactly. And then, of course, you've got the ever-changing nature of the financial world to contend with. New regulations, new technologies, new market trends popping up all the time. Your models need to be able to adapt to all of that.
It's like trying to hit a moving target, isn't it?
Yeah.
So basically what I'm hearing is that financial modeling is inherently tricky because it's this whole interplay of assumptions, data, model design, and the ever-changing nature of the financial landscape itself.
You nailed it. It's that combination of factors that makes financial modeling such a challenging but also a fascinating field to work in.
Okay, so we've established that financial modeling can be a bit of a beast to wrangle, but the article goes beyond just theory. It dives into some real-world examples of companies that have stumbled because of flawed financial models.
Hmm.
And I think these cases can really highlight the potential consequences, the real-world stakes of getting this wrong.
Definitely. I think they offer valuable lessons for anyone involved in this field, regardless of experience level. A good place to start might be WeWork. Their rise and fall was pretty spectacular. Valued at billions, then boom, everything comes crashing down. What went wrong there?
Yeah, their story is definitely one for the books. It seemed like they were on top of the world, and then suddenly,
Well, their models were built on some pretty aggressive growth projections, right? They were essentially valuing themselves as a tech company, assuming super rapid expansion and really high occupancy rates in those co-working spaces.
so a mix of Silicon Valley hype and real estate.
Exactly. But when they were gearing up for their IPO, the cracks in that model started to show. They hadn't really fully accounted for the costs associated with that rapid expansion or the volatility of the real estate market itself and the business model itself. Well,
Yeah, it wasn't as disruptive or as innovative as they had initially claimed, was it?
turned out to be much less sustainable than their models had suggested. I think the WeWork case really highlights how crucial due diligence and realistic projections are in this game.
It's a good reminder to stay grounded, even when the hype is swirling around you. All right, let's switch gears to another company that faced some serious financial troubles, although for different reasons. General Electric. Once upon a time, they were a giant of American industry, but things started to unravel. How did financial modeling play a role in their decline?
Well, GE's financial models were notoriously complex, like really complex, spanning all these different business segments and involving some pretty opaque accounting practices.
So too much complexity was the issue.
In a way, yes, all that complexity made it really difficult for anyone outside the company, like investors and analysts, to understand what was really going on. To truly assess GE's financial health, there were hidden liabilities, underperforming assets, all these things lurking beneath the surface, masked by this intricate web of financial structures.
Sounds like a case of the model obscuring reality rather than illuminating it.
Exactly. GE's story is a cautionary tale about the importance of transparency and simplicity in financial modeling. If a model is too complex, it can become a liability rather than an asset.
Makes sense.
Mm.
Okay, let's move on to a company that's been in the news a lot lately, Boeing. Specifically, the 737 MAX crisis. This is a really tragic case that highlights the importance of considering those downside risks, those black swan events, the unpredictable things that can come out of nowhere and throw everything off course.
Absolutely. It seems like they may have underestimated the potential costs associated with those design flaws in the MAX, the ones that led to those tragic crashes. They also didn't fully account for the regulatory scrutiny, the grounding of the planes, the damage to their reputation, all the ripple effects.
The financial fallout was immense. Billions in losses, production delays, all those legal battles.
And those were consequences their models hadn't really prepared them for. I think this case is a stark reminder that sensitivity analysis, scenario planning, those what-if questions, they're not just theoretical exercises, they're essential for making sound financial decisions.
You got to be prepared for the unexpected. Okay, let's talk about a company that's a bit of a wild card. Tesla, known for their rapid growth and innovation, but also for a pretty volatile stock price. How do they navigate the world of financial modeling?
Tesla is an interesting case study, for sure, because their models are inherently subject to a ton of uncertainty. They're operating in a really dynamic industry, and so much of their success hinges on things that are difficult to predict. Battery technology breakthroughs, production ramp-ups, competition from other EV makers.
Sounds like trying to read tea leaves sometimes.
It can feel that way. They're constantly having to adjust their projections based on new developments and shifts in the market. I think the key takeaway from Tesla is that for companies in rapidly evolving industries, their financial models need to be flexible, adaptable.
Okay, last example. Let's rewind a bit. Let's talk about Blockbuster and Netflix. We all know how that story ended.
Blockbuster is a classic cautionary tale about the importance of adapting to change, and that applies to financial modeling as well. Their models probably didn't foresee how quickly consumer behavior would shift and the disruptive power of streaming.
It's a stark reminder that even if your model is perfect for today, it might be totally obsolete tomorrow if you're not constantly evaluating, updating, making sure it reflects the reality of the market. Otherwise, you risk becoming the next Blockbuster, clinging to a business model that's no longer relevant.
Exactly. And speaking of assumptions, that's actually a good place to pick up in the next part of our deep dive. We've talked about why they're so crucial in financial modeling, but haven't really explored how to make them more accurate, more robust.
You're right, we've laid the groundwork, but now it's time to get into the nitty-gritty of actually building a solid financial model. I'm ready to roll up my sleeves and dig in.
Sounds good to me. Let's get to it.
Welcome back to the show, everyone. We're diving right back into the world of financial modeling, picking up where we left off. Last time, we talked about why it can feel so complex and tricky, and now I'm excited to get into the practical stuff. How do we actually tame this beast and build models that don't lead us astray?
Well, I think our source article gives us some great guidance on that, no matter where you're at in your financial modeling journey. One thing it really emphasizes is the power of simplicity.
Oh, music to my ears. You're saying we don't have to jump straight into building some super complicated model with a million variables on day one.
Not at all. Starting simple is key. It's all about grasping those core concepts first, building a solid foundation, and then you can gradually add complexity as you get more comfortable.
Okay, I like that. It's like when you're learning a new skill, right? You don't start with the most difficult thing imaginable. You break it down into smaller steps, build up your confidence and understanding.
Exactly. And as you're building that framework, the article really stresses the importance of documentation.
Ooh, documentation. Confession time, that's not usually my favorite part of any project. It can feel a bit tedious.
I hear you. But honestly, good documentation is like a superpower when it comes to financial modeling. Think about it. You're clearly laying out all your assumptions, the formulas you're using, where all your data is coming from.
It's like leaving a trail of breadcrumbs, so you can always retrace your steps and understand why you made certain choices.
That's a great way to put it. And it makes your model way more transparent to anyone else who needs to understand it, whether that's a colleague, an investor, or an auditor. It just builds a lot more trust and credibility in your work.
Okay, you've convinced me. Documentation is cool. But even with the best documentation and a really solid framework, no financial model is going to be perfect, right? I mean, there's so many variables at play.
You're absolutely right. And that's why the article really stresses the importance of testing and validation.
All right, so how do we do that? Take the model for a spin around the block. Crash test it.
Not quite a crash test, but you're getting the idea. The article suggests testing your model against historical data. It's like a time machine for your numbers.
Ooh, I like that. So we're looking back to see how our model would have performed in the past using real data.
Exactly. That helps you spot any potential biases or errors that you might have missed and just gives you more confidence that your model is on the right track.
It's a reality check for your assumptions and your calculations. Makes total sense.
And then, alongside this historical testing, the article also highlights sensitivity analysis. Remember those what-if questions we talked about earlier?
Oh yeah, the fun part where we get to poke and prod the model and see what happens when things don't go exactly as planned.
Well, sensitivity analysis lets you do just that. You can tweak your key assumptions, see how those changes ripple through the model, and get a better understanding of which assumptions have the biggest impact on your outcomes.
So for example, we could see what happens if interest rates go up or if our sales growth is a bit slower than we initially projected. It's about exploring those different possibilities and understanding the range of potential outcomes.
You got it. It's all about gaining a more nuanced understanding of the model's strengths and weaknesses. And it helps you focus your attention on the areas where you might need more data or where your assumptions could be a bit shaky.
It's like pressure testing the model, see where the weak points might be.
That's a great way to think about it. And finally, I think it's important to remember the human element in all of this.
Oh yes, let's not forget about the humans behind the numbers.
Exactly. Financial modeling can feel very technical, but at the end of the day, it's about people making decisions and taking action based on the information these models provide. So the article encourages collaboration. Don't be afraid to share your work with colleagues, get feedback, bounce ideas off each other.
It's about recognizing that even the most experienced financial modelers don't have all the answers, and that we can learn so much from each other.
Absolutely. And I think that leads us nicely into the final part of our deep dive. We've talked about the technical aspects, the testing, the documentation, but now I want to explore how we can use financial modeling not just to crunch numbers, but to communicate, persuade, and make a real impact on the decisions that shape businesses and economies.
I love that. It's like taking all those numbers and spreadsheets and weaving them into a compelling story that people can actually connect with and understand. So let's dive into that.
All right, welcome back to the show, everyone. We're in the home stretch now, wrapping up our deep dive into the world of financial modeling. And I have to say, this last part is what I'm most excited about. We've talked about the challenges, those cautionary tales, the importance of starting simple, testing like crazy. So, now what? How do we actually use all this knowledge to build better models, whether we're just starting out or we've been doing this for years?
Yeah, I think this is where the rubber really meets the road, right? And our source article has some great advice for us, no matter what our skill level is. One thing it really emphasizes, especially for those who might be new to this, is don't be afraid to make mistakes.
Yes.
Financial modeling is a complex skill. It takes time, it takes practice, and you're going to mess up along the way. That's just part of the process. I think that's such an important point. It's easy to get intimidated by something like this, to feel like you need to be perfect right out of the gate. But that's just not realistic.
Exactly. It's all about embracing that learning curve, being willing to experiment, to try things, to, mess up sometimes, and then learn from those mistakes and keep getting better. The article also makes this really important point about the need for continuous learning.
Oh, tell me about it. It feels like the world of finance is changing at warp speed these days. New regulations, new technologies, new market trends popping up all the time.
It really is. And if you're going to stay ahead of the curve, you've got to be a lifelong learner in this field, whether it's taking courses, attending conferences, reading all those industry publications. Heck, even just following thought leaders on social media can be helpful.
It's about being proactive, constantly expanding your knowledge, your toolkit, right?
100%. And then there's the question of choosing the right tools and software, which can be really daunting for people just starting out.
Right. There's Excel, which everyone seems to use, but then there's all this more specialized financial modeling software,
hmm
programming languages like Python.
hmm
It can feel like a whole different universe.
It can. The article suggests, starting with the basics, get comfortable with Excel, really understand its capabilities, and then, as you need to, start exploring those more advanced tools. But it's important to choose the tools that align with your specific needs, your goals, right?
So if you're working with those massive data sets, or maybe you need to automate some really complex calculations, a programming language like Python might be the way to go. But if you're collaborating a lot with others on a model, maybe a cloud-based platform like Google Sheets makes more sense. It's about matching the tool to the job and, becoming really proficient with whatever tools you choose.
Couldn't have said it better myself. It's
Yeah.
not about using the fanciest or most complicated tool just because you can. It's about using the right tool effectively, understanding its strengths and limitations.
Okay, let's talk about assumptions for a minute. We've discussed how crucial they are in financial modeling, how they can literally make or break the accuracy of your projections. What are some tips for working with assumptions effectively?
Well, the article really emphasizes transparency.
Yeah.
You need to be upfront about your assumptions, document them clearly, explain your reasoning behind each one. It's not enough to just make an assumption. You've got to be able to justify it.
And you've got to be realistic too, right? Avoid that temptation to be overly optimistic, especially when it comes to things like growth rates or projected revenues.
Hmm.
Better to err on the side of caution and build in a margin for error.
I completely agree. Finding that balance between ambition and realism is so important. And then, once you've made your assumptions, don't just treat them as gospel. Regularly review them, revise them as new information comes in and as the world around you changes.
It's an ongoing process, not a one-time thing.
Exactly. And I think all of this ties back to what we were talking about earlier about continuous learning, about constantly adapting and refining your approach.
It's a mindset shift, right? From thinking of financial modeling as something static and fixed to seeing it as this dynamic, iterative process.
Yes. And to wrap things up, I think the article offers one final, really powerful reminder, especially in today's data-driven world. Focus on the story your model is telling.
Ooh, yes, the story. Don't get so lost in the weeds of the numbers and the spreadsheets that you lose sight of the big picture, the narrative that those numbers are painting.
Right. A financial model is ultimately a tool for communication, for decision making. Use it to tell a compelling story about a company's financial health, its future prospects, what's driving its performance. Help people understand what those numbers really mean.
This has been such an eye-opening conversation. I feel like I've gained a whole new appreciation for what financial modeling can be, what it can achieve. It's not just about technical skills, it's about strategic thinking, communication, storytelling.
Exactly. It's a multifaceted field, and that's what makes it so fascinating and rewarding. And for all our listeners out there who are ready to dive deeper and hone their financial modeling skills, I highly recommend checking out the full source material we've been discussing today. It's packed with even more great insights.
Yes, definitely check it out. And as always, we'd love to hear from you, our listeners. Share your thoughts, your questions. Let's keep this conversation going.
Absolutely. Let's keep learning from each other.
That's what it's all about. Thanks for joining us on this deep dive, everyone. Until next time, happy modeling.